What's up, everybody, and welcome to the Meet Kevin Report number 3. Now, today we have some shocking news from the Federal Reserve, and it's not the kind of news that you should be expecting. We're going to break that down first, and then we're going to follow that up with some strategies for 2019 investing. We're going to talk about Minority Mindset's comments on debt and why I think his advice is wrong. We're going to touch on what Stephan missed on credit. We'll talk Gary V on failure during the next recession, whenever that shall be, and some dude about habits who had a viral video, and I may as well give you the bottom line with my opinion on that video. Let's get into the Meet Kevin Report 3. If you're not familiar with what the Meet Kevin Report is, well, I'm Meet Kevin, and I summarize some videos that I've seen on the YouTubes and a ton of financial articles, because that's pretty much what I do all day long, is I read and I drink coffee. Now cheers to that. Yeah, that's a glass straw. I'm trying to save the turtles. Oh yeah, and in case you're wondering why I'm dressed up, that's because I'm a real estate broker. I help people buy and sell real estate, and I teach you how to buy and sell real estate as an agent and as an investor in the courses linked below. Let's get right into what's going on with the Federal Reserve. Here's the bottom line. As market prices increased from 2017 to the summer of 2018, and the Trump tax plan came into effect and really kind of boosted spending by companies and corporations, we saw a surge in the stock market in Q1 of 2018, which some people have called the beginning of a bubble. We very quickly saw a hawkish Fed in the summer go, whoa, 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 things are blowing up a little bit too much here, folks. We gotta come in, be the coolers to this party, because things are getting a little out of hand. Somebody put something in the punch. So what did the Fed do? The Fed started raising rates, and that accomplished, along with the actual impacts of the Trump tax plan, a slowing in the marketplace. This is why in Q3 and Q4 of 2018, we saw significant weaknesses. October was a terrible market for stocks, unless you were shorting the market, and the real estate market plummeted through last summer, a good 8 to 12% in many areas, with areas like California and New York leading the plunge. As a result, throughout Q3 and 4, I posted a lot of videos, and so did a lot of other people, going, Federal Reserve, please stop raising the federal funds rate, which has an effect on increasing mortgage rates. And so that is exactly what they did. At the end, in December of 2018, the Fed said, okay, you know what, we're gonna take a little bit of an easier approach. Well, this Wednesday, the Fed came out and suggested, you know what, we're done raising rates for 2019. We're not going to raise them at all, and maybe we'll only raise rates once in 2020. And you might be thinking, well, that's great, Kevin, because everybody kind of wanted them to stop. That would be good news for the economy, right? That's what we think. The problem, however, is the underlying rationale from the Federal Reserve has actually led people to be a little bit more nervous than you might think. That is, the Federal Reserve suggested, oh, yeah, okay, we're not going to raise rates because we think GDP is actually going to slow down much more significantly than we thought as a result of this slowdown in gross domestic product and what we're expecting, a slowdown in hiring, and we're expecting the unemployment rate to increase a little bit. We're going to chill out a little bit. This sent signals to the entire marketplace that while this is ordinarily good news, maybe we need to be a little bit cautious, that the overall global economy is slowing down much more significantly than we anticipated last year. Because remember, beginning of 2018, everything was euphoria. Now, everybody's hitting the brakes a little bit. And this is also evidenced in how consumers are beginning to behave. Consumer spending is down. Jumbo mortgage refinances are down. Now, this is understandable because even slight increases in interest rates kind of make people with big amounts of debt not want to refinance. Now, the flip side is true now. Refinancing might be a good idea, but this is where I come up with my advice for 2019. While the Federal Reserve has done a complete U-turn from their hawkish stance from last summer to the dovish stance of now, I highly encourage you to consider a couple things before you refinance. 1, how stable will your income be during a recession? And 2, do you really need to do what's called a cash out refinance right now that is increasing your leverage? Right now, I would highly recommend folks consider home equity lines of credit, capitalize maybe on higher values that exist, and before you take out more debt or go into risky projects like flipping real estate, consider just hold on a little bit, be a little bit more conservative. Now, we do see a lot of people suggesting that there is no sign of a clear kill shot to our economy, that we're just adjusting to new low levels of growth. I'm still recommending you be cautious and really look for the wedge deals that we always look for in the real estate investing course. Don't know what the wedge is? Let me put it very simply for you. If you could buy a place for $350, put 50 grand into it, and it's worth $5, that means you're into it for $4 and it's worth $5, you have a wedge or an insulative, protective blanket protecting you, insulating you from potential crashes by $100,000. That's nice. We like that. We like insulation. We like safety. Those are the kind of deals that I'm advocating right now. I'm not recommending quick flips with risky potential profits, and I'm certainly not recommending high interest rate debt. This is where, I'm sorry, Mr. Minority Mindset, I have to hit you in that when you suggest
the first scenario is you have high interest debts that are costing you 12% or more a year in interest.
I'm blown away that you picked 12% because the number I use is like 7%. That is, if you're paying student loans, credit cards, or car debt and the rate is above 7%, I do not think you should be jumping into investing right now. You should be paying off that debt, because if our global economy is going to adjust to lower and slower growth, after all, look at the European Union where they have negative interest rates at the European Central Bank. Yeah, negative interest rates. That means if you put money in a bank, you actually lose money. Pretty crazy. Anyway, back to the United States, or really wherever you are. I would highly encourage you to peg that number at 6 to 7, maybe 8%. Any interest higher than that, pay it off. That is the best investment that I would recommend right now from the point of view of a real estate agent for entertainment purposes only, because I am not allowed to give financial advice. I just make videos on YouTube.
Right now, your only focus should be to pay down these high interest debts as fast as possible because they are very, very, very expensive.
As a result, I much prefer and liked Zachary's comment on Minority Mindset's channel where he says pay off your debt above 6% first. If you have a mortgage at 4%, then it's better to invest in stocks with an average return of 8%. But any credit card debt, pay off ASAP. I could not agree more with this comment. Excellently done. Now we're going to transition a little bit over to Stephan, where he gives 5 mistakes to ruin your credit score. Folks, I think some of them we would already expect, such as a high utilization rate of our credit cards and also missing a payment. Never miss a payment. Check all your stuff twice a month so that you don't miss a payment. Make a spreadsheet, check it twice a month, and then you won't miss a payment. And set the stuff up on auto pay and pay it off every month, and then you can't miss a payment. But anyway, there was one very important part that I think Graham missed, and it is a sign of, well, the jaded economy that we kind of need to be in today. You need to freeze your credit, aka lock your credit. Your credit can still grow when your credit is frozen. But give this a Google. Experian credit freeze, TransUnion credit freeze, or Equifax credit freeze. Educate yourself about freezing your credit. I just froze my children's credit, and they are 1 and a bit and 3 and a half. And I froze their credit. Oh, and our credit is frozen too. You should do it as well. Your credit still goes up. It just gives you basically a nice personal PIN code so that if you want to apply for new debt, you have to unlock it with a special code. So that way, people can't steal your identity. And if you think, oh, well, I don't have a Target credit card or Home Depot credit card. Those loser companies got hacked. I have a better credit card somewhere else. Well, you cray, because Experian got hacked, and if you don't think your date of birth and social, which by the way is all you need to steal your identity, is out there, then you cray. Now, speaking of crazy, we can head right on over to Gary V, who tells us that a lot of the fake Lambo rentin' entrepreneurs out there are going to get spanked.
And that's why I have so much cynicism towards the people that rent Lamborghinis to make it look like they own it, because this is going to be a mental health issue. My number one fear, because entrepreneurship at scale is going to fail during the next economy collapse.
I actually thought he had a pretty cool point of view that, hey, you know what? We have a society that has been coddled and we need more people willing to embrace failure.
I'm substantially worried about this because I think we're talking about a generation that was over-coddled by modern day parenting. I think we have to stop giving 7th place trophies. It's bad for kids.
And a lot of people are going to get flushed out for failing because they're not going to be used to failing. And I, for one, will agree with this and say, I fail all the time. Don't sue me, bro. Oh, but I mean, I actually wanted to reference Valuetainment's chart here because that's almost the story of my life. So we'll put that up. Thank you very much, Gary V and Patrick Bet David. Now, over and above to the viral video on one thing you could change in your life, that one habit you could change in your life.
And the question is, why did Tom not stick with his good new habits? And the main reason why Tom and why most people don't stick with good new positive habits is because they don't possess the most important habit, which is something called
commitment. And nobody really cares about the definition they give for commitment, but what we do care about is the message that he embodies in this viral video. That if you want to make a change, you want to go to the gym 3 times a week. Don't go from 0 to 3 times a week. Start going once a week.
And I would also recommend just focusing on one new habit at a time. You can try doing a few at a time, but usually you'll end up exactly like Tom. But if you really do feel like you can take on more, then go for it.
The same can be said about investing in real estate, which is what I encourage you to do in the real estate investing course or even as a real estate agent. Don't try to go from 0 clients to 20 clients. Don't try to go from 0 to 30 units. Start with 1. Get your feet wet, get started, start feeling it. And then you could go to the gym again. Then you can buy another property. Then you could move on. Thought it was a really great reference and a great way to cap off this video because guess what? If the market is going to be in a slower growth direction, if we're going to be more focused on paying off debt, then folks, I highly recommend you start commitment. Start committing to investing. Start committing to yourself and your own personal goals in a smaller way than you've been used to. Because the last thing we want is high risk, high reward at a time like this. But what is definitely not high risk is smashing that like button and clicking subscribe and following me on Instagram because, well, if you follow me on Instagram, you can send me some tips, and I need some tips, because you see this iPad here? I could fit a lot of articles and tips on here, so please, send them to me. You can also click one of these other videos. Thanks, folks. Have a good one.